Adjustable rate mortgages, what are they? Why have they become so popular? And is it right for you? We're diving into that and more right now. Let's do it. Today we're here with Matt Kuglin, lender extraordinaire, and thank you for joining me today. We are talking about adjustable rate mortgages.
Yes.
And so, first of all, just introduce yourself and tell everybody who you are and what you do.
Absolutely. Thank you for having me, first off.
Absolutely.
But Matt Kuglin, I'm a mortgage broker. I've been in the mortgage business for over a decade now. I've done everything from originating to actually managed 15 loan officers at one point in time in my career. Born and raised here in Georgia. I've got a beautiful wife and a 2-year-old daughter. So I'm happy to be here with you.
2-year-old daughters, I can relate to that.
Yeah.
So awesome. So thanks for joining us. And the first thing I want to ask is this whole thing about adjustable rate mortgages. I've been in the business 9 years, and I've actually never had a client ever use it or ever ask about it. But all of a sudden, it seems like that it's become this big thing. So first of all, what is an adjustable rate mortgage? Tell us more about that.
Yeah, and it is. It's picking up in the market. We're seeing a lot more clients that are asking about adjustable rate mortgages. Basically, the difference between an adjustable and a fixed rate is exactly what you'd think. It adjusts after a certain period of time. So there's 3 main options. There's a 5-1, there's a 7-1, and a 10-1 arm. And it's fixed for that 5-year, 7-year, 10-year period, and then begins adjusting based off of where the interest rates are at that time.
Okay, so let's take a step back. So 5-1, 7-1, and a 10-1, is that what you said?
Yes. Yeah.
Okay, so what are the numbers there? What is the 5-1? What do those numbers mean?
So ultimately, it just means that it can adjust every year.
Okay.
With a 5-1, 7-1, 10-1.
And when you say it can adjust?
The interest rates.
All right.
Yeah, interest rate can adjust, yeah.
Okay, so the difference between an ARM, adjustable rate mortgage, and a fixed mortgage is adjustable rate mortgage, your interest rate's changing.
Yes.
And the fixed rate, it stays the same for the life of the loan.
Absolutely.
All right, so with that said, let's talk about adjustable rate mortgages becoming a bigger thing right now. Why is that?
Affordability. That's what's driving it right now. So one of the biggest differences, other than the fixed versus the adjustment part, is an ARM's going to have a lower introductory rate. So let's say 6% is what you can get on a 30-year fixed. Looking at a 5-1 ARM, you may be able to get a 5.5 or a 5.375. So people, they want their payments lower, and we got a little bit spoiled with 3%, 4% interest rates. So this is a way to combat that and ultimately give that client a lower introductory payment for the 5 years, 7 years, or 10 years.
Okay, so it sounds like when you first come in, this is a great thing when you first start. What happens to it as you go along? So let's just talk about a 5-1. Put one out there. So 5-1. I started at 5.375 as opposed to 6 right now or whatever it is.
Yeah.
That's great to start, but what's going to happen as the loan goes on, and why does it happen?
So there's 2 things that can happen. Once you get outside of that 5-year fixed time period, let's say rates have moved up nationwide to 10%. There's going to be a cap on that 5-1 arm. Normally they're at 5%. So if you started out at, let's just use 5% as an example, it's gone up to 10%. Your rate could adjust to 10% over the life of the loan. Something better for the clients could end up taking place and rates could dip. And with an adjustable rate mortgage, you can float down and the rate ends up going below what you started out.
So will it always go and match the current rate once it gets to that 5 years? Or is there something that's like, oh, if the new rate's 4, let's say, but you're an adjustable rate mortgage, we'll only go down to 4.5. Does it do anything like that, or is it always going to match?
No, it's normally going to match, and it's a little bit different than what the exact 30-year fixed is. It's based off of LIBOR, prime rate, that type stuff. So a lot of times you're actually not seeing as big of a hike as somebody who's going to buy a house at that same time and getting that particular rate. So it's based off of a little bit lower tier than what people are actually getting.
Let's go back to the 5-1. So is that rate that you're introduced at, that stays for how long? 5 years?
5 years.
Okay.
Yeah. And then you get notified. It's not like all of a sudden your payment switches. You're getting notifications of, hey, this is what the projected interest rate's going to be. This is what your payment would move to. And a lot of times people take that opportunity to potentially refinance, or they say, hey, I still feel comfortable with this and I'm going to stick in this loan.
So I guess the question is, after 5 years, we're saying the rate changes. What happens from that 5-year point on in terms of the interest rate of the loan?
Yes, and that's going to be based off of what type of ARM that you get. So some adjust every 6 months after that 5-month time period. Others adjust every 12 months. So you're going to, let's say it moved to 5.5% from 5. you'd stay at that 5.5% for 6 months or 12 months, and then it would adjust again based off of where the market is.
For those that are watching out right now, who would the adjustable rate mortgage most benefits, and who should be like looking at that as a possible option?
The biggest client that it impacts and is beneficial for is someone who knows I'm only going to stay in the house for X amount of time. I'm either relocating or planning on growing in family size. We know we're going to move in X amount of time. And what I try to do, from a consulting standpoint is, okay, if you think you're going to move in 4 years, great. Maybe a 5-year would make sense. If you're thinking 5 to 6, let's make sure, we're fixed for 7 years. Just making sure we've got, that fixed time period that's going to make sure we overlap in the time period that the client feels like they're probably going to move from the house.
Who would you say this doesn't match? Is it for that person that thinks this is a 15, 20-year, or 30-year home that just doesn't make sense for them to get that type of loan?
Yes. Yeah. If you've got long-term plans to stay in the house, the majority of the time it does not make sense for you to be looking at an adjustable rate. In that type of a situation, it makes more sense to look at buy down, where you're paying some of the interest up front and reducing, your payment each month. That type of client, I would not, start showing ARM options to.
And so let's talk about, all right, I think that I'm going to stay for 4 years in the house. You get a 5-year ARM, and then all of a sudden, nope, I'm staying for much longer. What happens then to that client if you're looking at rates that maybe you got in it for 4.375, and now the rate you're looking at after 5 years is 6.5 or 7?
Most people at that point in time, they refinance. And again, as I was just talking about with the buy down, a lot of times with the refinance, you can do the same thing to try to keep that rate as close to what you've got now. But most people, if plans change, which that happens, to everybody, just looking at refinancing and potentially getting in a fixed rate, that's what makes the most sense.
Let's go back to getting an ARM real quick. You talked about after 5 or 7 or 10 years, the rate will change. It could be 6 months, it could be 12 months.
Sure.
That's established when you first get the loan. What's the difference between getting it a 6-month or a 12-month change?
So different investors will give you different pricing. So sometimes, and it just depends on the appetite of the market, appetite of the investors. Sometimes the 6-month change after that fixed time period, that's more attractive. Sometimes that year-long stint where it's fixed for 1 year is more attractive. So it really just depends. And that's what, where I come in and I'm saying, hey, here are your options. This is what if we're doing a 1 year or a 6-month term, this is what this looks like. And then I'll, always go through 5, 7, 10, just to kind of let my client understand these are the rate differences on each one.
Is there anything with ARMs that I don't know about that I should ask you about right now that you would have answers to?
No, it just, ARMs, it's pricing on ARMs move. What's the best way to explain this? The pricing on ARMs change more dramatically and more frequently in the market. So 30-year fixed rates, it's like you can watch the national average and you know what's taking place. ARMs, like this morning, I priced out a 5-1 ARM. There was nothing that would have caused it to drastically drop below a 7-1, but it did. It's all based off of that investor appetite for this type of product. So different times it makes sense, and that's why it's always smart for you to talk to your mortgage broker, your loan officer, and find out, okay, what do rates look like for this now? What does it look like today? Especially when you're getting close to going under contract, because what may have made sense 2 weeks ago doesn't now, and vice versa.
Hey, I hope you love this video about ARMs. If you have any questions, you can contact me or contact Matt. I'll put his info below. If you're looking for a great lender, Matt is your guy. He lives in Georgia, I know. Do you live anywhere else?
Yes, Florida, South Carolina, Alabama.
That's awesome. See, I don't work those states. I just work in the state of Georgia, but if you're looking for an agent down there, you can contact me too, and I can help you get connected. If you like this video, you might want to take a look at this video here that talks about renting versus buying. It's the best breakdown that you can find out there. I promise you it'll be worth your time. Thanks, and we'll see you next time.